We are proud to announce the 2019 Palisade Global Hard Asset Conference, taking place on Jekyll Island from May 16th to May 20th. Speakers confirmed include one of the most successful venture capital fund managers within the resource space, Marin Katuso, legendary mining investor Paul Matizek, former hedge fund manager Mike Alkin, and CEO at US Global Investors, Frank Holmes. All these guests, plus many more to be announced. Sign up now for more details and to be included in our special guest list. Join us in Jekyll Island to become part of a growing number of investors who are ready to take advantage of a coming resource boom. Welcome back to another episode of Palisade Radio. I'm your host, Karema Mutlu, and on today's show, we have Ronnie Stöeferle, who is the managing partner and fund manager at Incrementum and the author and publisher of the annual In Gold We Trust report. Welcome back to the show, Ronnie.
Hi, Karen. Glad to be back again on the show. Thanks for the invitation.
Let's begin by talking about gold. Is a more bullish setup for gold now beginning to come into focus? A number of factors have recently come into play that could potentially turn the attention back onto gold. If we look at the current weakness and volatility within the stock market, a weakening real estate market in certain countries, and a sense that investors are starting to perhaps to begin to worry about a possible recession in regards to China and the US especially, does this give gold the tailwind it needs going forward?
Yeah, it is actually the perfect storm for gold, I would say. As you might know, our inflation signal turned to rising inflation at the beginning of January, which led us to the conclusion that we have to load up on inflation-sensitive currencies like the Canadian dollar, the Australian dollar, mining equities, especially silver mining equities, gold itself, silver, and the commodity space in general. Now, what is the reason, the interpretation for that scenario, while basically everybody is talking about deflationary risks at the moment? We have said quite often recently that the combination of quantitative tightening and rising rates in the US is gonna lead to recessionary risks, and we can basically see all along the economic numbers coming out that the economy is cooling down dramatically. Now, Donald Trump, of course, with his last fiscal stimulus last year at a time where we had full employment and where we've been basically at the top of the cycle, that was basically the Keynesians' wet dream. So it made the whole cycle a bit longer, but it is absolutely certain that the recessionary clouds are getting darker and that they're coming closer. Now, this in combination with QT and rising rates is, of course, something that, from our point of view, will lead to the monetary U-turn that we have described quite often. And yesterday at the press conference, I think it was very, very obvious that Jay Powell has made a big turnaround in the last couple of weeks. Well, we know his infamous long way from neutral command. That was in October, and since then the S&P was down 20%, and this led the Federal Reserve to make this monetary U-turn. But it's not only the Federal Reserve, it is also the People's Bank of China that has already become more dovish, and it's also the Chinese government that just implemented massive fiscal stimulus. So we have seen that the market is addicted to cheap liquidity, and as soon as the, let's say, liquidity party, the safety net of low and ample liquidity for the markets, as soon as this is taken away, the economy but also financial markets get nervous. So gold and commodities, but also the dollar are discounting that major central banks will become more dovish again, and that is actually the perfect storm for the gold space.
Back in the summer last year, you suggested that 1250 was perhaps the low in gold. And since then, gold is still above that level for now and is pushing around the $1,300 area. So for investors, will their patience be rewarded within the gold space later this year? There still seems to be much skepticism that gold will never reach $1,400 again. And even if it does, it will simply fall back down to the $1,200 range. But I would argue the skepticism is perhaps still needed for gold to surprise to the upside. What are your thoughts, Ronnie?
Absolutely. I mean, gold just hit an 8-month high. And I think it's funny how the gold community that is not as big as it used to be, the mood improved in the gold community, and everybody's cheering that gold is finally up above 1,300. But my long-term target has always been 2,300 US dollars. And if we remember back in 2011 when gold hit 1,900, all the major investment banks, all the Wall Street banks were extremely bullish on gold. Their target prices were 30, 40, 50% above current prices, which were at 18, 1900. So we are far away from Main Street being bullish on gold. We have just seen the numbers coming out from the World Gold Council for 2018, and actually ETF demand was 68.9 tons of gold last year, which is 3.4 billion US dollars. That's a ridiculous amount of money nowadays. And from my point of view, ETF demand is very much representative for institutional investors investing in the gold space. We have also seen that central bank buying was the biggest in 50 years. So central banks, especially Russia, Turkey, Kazakhstan, they have bought 650 tons, which is the biggest buying since the dissolution of Bretton Woods Agreement. So we can see that demand is kind of picking up, but not from investors at the moment. Now, talking to investors and especially institutional investors quite a lot, we can see that they are still on the sideline. They all had a really rough 2018. Now, since the beginning of the year, of course, equities are up. I would say that this is rather a bear market rally. But I know from many conversations with institutional players that they all want to get into gold again, but everybody is kind of indecisive about the exact timing. So I think going forward, FOMO, fear of missing out, will be a big factor. I know that 1360, 1380 is a massive resistance zone. But as soon as we're above this resistance, I think we can easily go to 1450, even 1500 in the course of this year. So my call has always been that the first phase of this bull market started in 2016. This was the accumulation phase, where contrarian investors bought into gold. The gold price stabilized, mining equities also kind of stabilized, but it was also quite a volatile ride. Now we're at the beginning of the second stage of the bull market, which is, according to the Dow theory, the public participation phase, where Main Street investors, they will become more optimistic. Analysts become more optimistic. We see institutional players getting into the field. So therefore, the party is just starting, perhaps 7 p.m. and the guests are slowly coming in, but the party will really get going in the next couple of months and years.
Excellent. Let's move on to a couple of key takeaways from your latest In Gold We Trust report. One part that I particularly liked was you talking about the Fed and how it's convinced the markets of its commitment to normalizing monetary policy by hiking interest rates and contracting its balance sheet. You suggest that this will eventually lead to a recession. So if we are going to have a recession and another global crisis, do you imagine the gold and silver equities will fall with the rest of the market? Or are we already at such a low starting point for the precious metal equities that there's little mitigated risk of any further falls happening?
Well, if we compare the current setup to 2008, I think it's very different because in 2008, gold and especially the mining equities were trading at new all-time highs. And of course, we have seen in 2008 in these dark moments in September and October that everything was just sold off, and also mining stocks were sold off. And for the whole year 2008, gold was actually up. I think 5.7 or 5.8%. So the performance of gold was pretty good, and then mining stocks recovered much earlier than the general market. And we know that from 2008 until 2011, that was basically the final stage of the bull market when gold hit a new all-time high at 1900. So now, if we compare that to the current setup, the GDX, for example, is now trading at 22. It used to be at above 60 in 2010, 2011, for example. I think nobody is really invested in the mining space. When I'm talking to institutional players, they are just not interested in mining equities at the moment. And I think that the current merger mania, we have seen the deals Barrick and Randgold, but also Newmont and Goldcorp. I think they're a sign that we're at the bottom of this cycle. So normally such big takeovers or mergers happen either at the bottom or at the top of a bull market and of a market trend. So I think the mining companies, they did a tremendous job, at least some of them. In the last couple of years, we have seen creative destruction, as Schumpeter would have called it, in the sector. So companies strengthened their balance sheets. They got rid of projects. They reduced risks. They changed management teams. So from my point of view, the leverage of mining stocks on a rising gold price is higher than ever, and that's basically why we loaded up in our fund on mining stocks in the last couple of months. And we will see that with rising investor demand in gold, there will also be significantly rising investors' demand in the mining space.
Very good. Okay, Ronnie, as we start to wrap up the show, is there anything else on your mind at the moment that you wish to share with our listeners?
Well, we're already in the process of writing our 2019 In Gold We Trust report. It will be released end of May. We will also publish it for the first time in China, so there will be a Mandarin translation of the report, and therefore we will also cover the topic of de-dollarization quite a lot, and I think this is really a medium to long-term topic that is getting increasingly important, and I think this is really something that that investors will have to have in mind. Just have a look at the US dollar. From my point of view, although interest rates and the differential to the Eurozone, for example, has been growing significantly, and of course the United States, the Federal Reserve, they've got room to maneuver and to lower rates as soon as recession risks really appear. But still, from my point of view, the US dollar would have to be significantly stronger. So it is not the news itself, but rather the reaction to news. And from my point of view, the dollar is in the process of rolling over, and that will have significant consequences for gold, of course, but also for the commodity space, for commodity-related currencies. And from my point of view, the risk of a significant devaluation of the US dollar is something that is not really a big topic at the moment, but it will become a major topic in the next couple of months.
Very good. Okay, well, thank you very much for your time today, Ronnie. Thanks for being on the show, and I'm sure we'll have you back on again later in the year.
Thank you very much. It's been a pleasure as always. Take care. Bye-bye.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?